Let's dive right in.
Dive
So
in because they need to know this. This is
yeah,
important stuff.
absolutely. The $1 trillion source. This is one of my favorite topics. And one of the reasons why I absolutely love this is it works for everybody. And what I mean by that is it works for everybody that wants to take back control, that knows that they can have more in life, that they can do more in life, that they can be more in life if they just had the right opportunity, if they had the right education, if they knew the action items to go out there and follow step by step exactly what to do. And this will allow you to do it. But why I say it's for everybody is the $1 trillion source. This is a strategy and a vehicle that you can learn about and you can implement if you have millions of dollars. You can implement this strategy if you're very, very wealthy. You can implement this strategy if you're dead broke, if you have no money, if you're just starting out. You can implement this strategy if you're approaching retirement age or in retirement, or maybe you're 20 years old, 30 years old, and you're completely fresh and you've never had a retirement before. And you can go out there and you can start this and become successful from it and use these strategies that we're going to teach you. Whether you have money or whether you don't have money, pay very, very, very close attention to the next 20, 30 minutes here, because we're going to get into what we call the $1 trillion source, which is the self-directed IRA. This is the new standard. So I'm just curious, before I dig deep into this, who doesn't know what self-directed retirement investing is? Who does not know what a self-directed IRA is? Just put I, like if maybe you've heard about it before, but you don't actually know how it works or what it is. Is there anybody that's just completely brand new?
Honoram said.
Just put I on there.
Kimberly said I. Shelly said I.
Okay, so we have a few people that we need to dig into this, Chris. So this is really just learned with you folks recently. Yeah.
Before you do that, Stephen, I just want to make sure that every one of them that said I, first off, it's not your fault. Okay. You weren't taught this because nobody ever had anything to earn by teaching you this. So I just want you to know that it's not because of anything you failed to do. It's not because of anything you failed to learn. It's simply they don't teach this, which is why what he's going to show you, only 4% of all IRAs out there, and I don't even know how many IRAs there are, probably billions, at least tens or hundreds of millions, only 4% of them are self-directed. So if that right there tells you anything, well, stay tuned because you're going to learn a lot more.
Yeah, I mean, absolutely. There's this that's actually a couple of years old, so it's over 80 million now, but there's over 80 million IRAs in this country with trillions of dollars within these retirement accounts, and less than 4% of those are self-directed. So it's surprising in the fact that just people are never taught this stuff, but it's not surprising when you look at data and numbers. Because if you go back to what Chris said earlier, less than 5% of people in the United States of America, less than 5% of people are going to be able to retire at the age and the lifestyle that they want to retire at without having to go work harder, or without having to go work longer, or without having to drastically change their lifestyles now to be able to budget for that down the road. Less than 5% of people in the wealthiest country in the history of the earth. Right? So why is that? Why is it that you always hear about the 1%, or you hear about, hey, 5% of people own 95% of wealth, and all the stuff that you always hear? Why is that? It all boils down to financial education, because every single one of us, like Chris, me, you, I mean, every one of us that's out there, I shouldn't say every one of us, but the majority of people that I know and I associate with and that I partner with and that I network with and know across the country come from very similar situations to you and I, Chris, where we didn't come from money. Like we didn't, I went to college for a few years and I paid for it all on my own. Like this is stuff that like we were never given to us. Like we're no different from anybody else. We just realized at a younger age, hey, there's something more out there. And if I just go study what other successful people are doing, if I say, hey, instead of learning from, this financial advisor that makes 60 grand a year talking about mutual funds, if I go and study what is Robert Kiyosaki doing, what's Tony Robbins doing, what's Donald Trump doing before he was president? I mean, the guy, a real estate investor, like what are people like that doing? And studying that kind of thing. What do the Rockefellers do? How do you create this legacy generational wealth? If I study that, hey, maybe I'll be a little bit better off in life, right? And that's exactly what I did. Chris, I know that's exactly what you did as well. And that's exactly what all of our students and members do to be able to create success and put themselves on a better path. And hopefully we have time. I'll pull up a couple testimonials from our students that just say, hey, like we were literally stuck. Like we thought we were never going to retire. We thought that our life was like like we didn't know what to do financially. Like we were in big trouble. And within a year, within 2 years, within 6 months, like our path now financially is we would have never dreamed that it would be possible. And we hear this over and over again. This stuff is not hard. It's not rocket science. It's just something that's a little bit different. So I love that slide right there. And I love just, pointing it out, but it all goes along with the data, and that's what it shows, right, Chris?
Absolutely. Hey, everybody, real quick, how many of you are 5 to 10 years away from retirement? If you're close to retirement, put yes into the chat. I want to know how many of you are 5 to 10 years, because I'll tell you what. So there we go. We got Shelly, she's 5 to 10. We got Mark's 5 to 10. Pamela's 5 to 10 years from retirement. And I'm sure there's going to be more, but here's the thing. And this is so important. So please, everybody, pay attention to this. The next 5 to 10 years are going to either make or break you. You have to be so unbelievably careful right now, because if all of you are retiring, that just said that, Kim and Gotham and all the other people that said they're retiring 5 to 10 years, here's the problem. In the next couple of years, I can't tell you when, because I can't time the market, but 1 year, 2 year, no longer than 3 years, you're going to have a major correction in the markets. How big? Some are saying, a lot of the economists are saying it's going to rival 1929. It's going to be a mix of 1929 and the dot-com crash of the 2000s. So if you mix those two, put them in the blender, and then mix in a little 2008, that's about what's coming. And if you're not ready for that, and you ride the roller coaster down, doing what everybody tells you to do, FOMO, fear of missing out, or the euphoria that's going on. Everybody thinks they're missing out on something right now. But if you get caught in this downward spiral, you're not going to retire in 5 to 10 years. And that's what me and Steven are here to teach you tonight. How not to get caught in that spiral. How not to get mixed up in the FOMO, the fear of missing out, the euphoria of thinking you got to jump in the market because you're missing out on something if you don't. That same exact thing. Study history, folks. I study way too much. Study history and look at 1926 to 1929. Everybody in 1926 to 29 was stuck in that same euphoria, that FOMO. They all thought the market was going to keep going up, and then all of a sudden it didn't. And those people weren't retiring in the next 5 to 10 years after that. Well, here's the news. It's not something you have to do. It's not something you have to go along with. It's not something you have to participate in. And what do I mean? You don't have to ride the roller coaster down. You don't have to go down with the market. What we're going to teach you right here and right now tonight, and in depth, we're going to show you the how-to this weekend in the 3-day event. We're going to show you how not to ride the roller coaster, but how to benefit from what's coming, how to see it as an opportunity, not an obstacle. So Steven, get into self-directing, because this is honestly one of the major answers to how you're not going to ride the roller coaster down, is simply you being in control of those retirement dollars that you have today.
Yeah, definitely. And, like you said, Chris, we talk a lot about the markets, and you're absolutely right. Like, it doesn't have to be that way. And that's what this is all about, is opening your eyes to alternatives, opening your eyes to new ideas and strategies that are proven to work. It's just a matter of going out there and doing them. So what does self-directed mean? Self-directed is plain and simple. It means you, not your financial advisor, are in charge of your investment portfolio. You decide what types of investments to make. You decide where your money is going to go to grow. Everything else when it comes to a self-directed IRA is exactly the same as a quote unquote non-self-directed IRA. So what I mean by that is an IRA at Fidelity, at Morgan Stanley, at Merrill Lynch, at any of these brokerage houses, at, I don't know, Robinhood, at Charles Schwab, any of these brokerage houses, these are just retirement accounts. Retirement accounts are retirement accounts. According to the IRS, a retirement account is a retirement account, meaning the same rules and laws apply to a retirement account at Fidelity as it does at, for example, Horizon Trust, which is a self-directed custodian, okay, which is the exact same thing. So what is a self-directed IRA? Self-directed, like I said, it's a descriptive, not a legal term, because they're all the same. So you can have self-directed traditional IRA, and we'll talk about the differences in these briefly, okay? You can have a self-directed Roth IRA. You can have a self-directed 401k or solo K. You can have self-directed health savings accounts, SEPs, Simples, any type of retirement account that you've heard of can be self-directed. The only difference is, do you control the money or does your financial advisor control the money through mutual funds and lifestyle funds and that kind of thing? So let's get into it. Which type of IRA is right for you? So you have to ask yourself the question, do you want tax-free income for the rest of your life, or do you want a tax deduction today? Do you want to pay taxes on the seed or the crop? Or do you want to have your cake and eat it too? So let me explain what I mean by that, okay? So a traditional IRA, and again, it can be a traditional 401k, a traditional HSA, SEP, simple, it doesn't matter. We're just going with traditional. What that means is the money that's going into that retirement account is going in pre-tax dollars. So your employer pays you, but before any taxes come out, anything like that, the money goes straight into the retirement account, okay? Once the money's inside of there, the money is going to grow tax deferred, meaning you don't pay taxes on it yearly. It grows tax deferred. Once you hit 59 and a half years old, which is retirement age, according to the IRS for retirement accounts, you can start to pull that money out without paying a penalty. If you pull that money out before you're 59 and a half years old, you're going to pay a 10% penalty plus taxes for pulling that money out. So basically, you're giving up control of your money, okay, in a retirement account in general, especially with the traditional. Now, they have advantages, possibly by getting that money in there pre-tax dollars, it can lower your taxable income for the year, dropping you to a lower tax bracket. So there can be some advantages to it, but I just want to talk about the way that they work, okay? So it goes in pre-tax, grows tax deferred, you pay taxes later on. The traditional way of thinking about financial retirement, okay? This is what your financial advisor is going to tell you. You're in your earning years right now, meaning your income is going to be at the highest it's going to be in your lifetime while you're earning income at your job, okay? So what that means is, let's go ahead and get that money and not pay taxes on it now. Let's get in that retirement account. And then later on in life, when you retire, you're not going to have as much earned income. So you're going to be in a lower tax bracket. So later on in life, when you pay taxes on that money, you're going to be in a lower tax bracket, so you're going to pay less money in taxes, right? But what is one of the challenges that can come from that? Let me ask this question. What is going on with taxes every single year in our lives? What do? Do they go up or do they go down? Up, 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 up. Okay. So we're all in agreement, taxes are going up, right? So why would you put money into an account right now that's going to defer paying taxes until later on when taxes are where? Up. Okay. Again, there's uses for traditional retirement accounts, but the way that things are going right now, I don't see a whole lot of uses for them, all right? 401ks can be useful at work. Again, they're giving up control, but sometimes you get the match. All right, we're not going to get into it. All right, so here's the other type of retirement account. That's a traditional. The other type is what's called a Roth retirement account. So a Roth retirement account, money goes in after taxes are paid. So I get paid, my paycheck, the taxes come out, whatever the case might be. I pay the taxes today. Once the taxes are paid, I take my money and I put it into a Roth retirement account. So a Roth IRA, a Roth Solo K, a Roth SEP, a Roth Simple, whatever, is a Roth account. So I take the money, I put it in there after I pay taxes. Once it's in that Roth account, here's what's awesome. That money now grows within my Roth account completely tax-free, meaning I never will pay a dime of taxes on any of the profit within that account. Now that sounds okay when we're talking about a traditional Roth IRA, meaning a Roth IRA at Fidelity or a Roth IRA at Charles Schwab, because what are you doing? You're investing your money in typically mutual funds or lifestyle funds. Over time, you might get, 8 to 10% returns annually over time. So your money's going to grow tax-free, which is cool. When you pull the money out at retirement age, you're never going to have to pay any taxes on it, no matter what's going on with taxes at that time. So all that profit, you never pay taxes on. So it's a beautiful thing, right? But let me ask this question. What if we could take that money, put it into a Roth account, and then go out there and invest in a business startup? Or what if I could take that money in 2010 and buy a ton of real estate? What has real estate done the last year? I don't know where you guys are, But where I live in South Florida, the real estate market is like nothing we've ever seen before in history. The prices have gone so crazy. The housing market is so hot right now that if you would have bought a home 4 or 5 years ago, you probably would have doubled your money. I mean, maybe not, but the way we buy houses, I know a lot of our investment properties have doubled or tripled in income. Chris, I know you've witnessed that a lot, even where you live up in Buffalo, right?
Listen, like Buffalo is not the place where people just clamor to live. You know, that might be Texas or Florida, used to be California, but Buffalo's real estate in some parts, we're seeing houses go 30% over ask. Literally $240,000 house just went 80,000 over ask. Like that, I'm sorry, but that might happen in your part of the country. That doesn't happen here. Like there's something crazy going on, and we all know what it is. Like COVID hit, everybody was like confined for a year. People are moving out away from the cities, bigger houses. There's a lot of reasons: cheap money, low interest rates, and lots and lots of stimulus money.
Yeah, I mean, it's crazy though, but I mean, look at this. If you would have went out there and bought a home for 100 grand, let's say in 2011, like a foreclosure, when all the foreclosures, we were buying all those foreclosures for pennies on the dollar, which by the way, who thinks that might happen again in the next few years? Anybody? I know you can't raise your hands, but put I in the chat box if you think that there might be some real estate foreclosure opportunities coming up in the next couple of years. I personally believe there's going to be a ton. There's been a lot of people that are on mortgage forbearances. There's a lot of issues right now with this economy, even though we're not really being told that. There's going to be a lot of foreclosures coming. And as soon as the deferrals end, absolutely, Thomas, I'm on the same page with you. So we're prepping right now to get ready for these. So there's going to be a lot of opportunities coming up again. So just be ready for it. If you missed out on 2010, 2011, 2012, even going into 2015, we were still getting killer deals. It's just been the last couple of years, they've started to dry up a little bit. But how many of you want to be ready for that? How many of you want to get into that? Because if I was to go out there with my Roth IRA and buy one of these rental homes at 100 grand, that thing goes up to $300,000 and I sell that thing in retirement. That $200,000 that thing grew, I never pay a dime of taxes on any of that money. If I go out there and I invest in a startup company, let's say put $20,000 in a startup that takes off and I make $500,000, can that happen? Absolutely. It happens every day in venture capital.
Yeah, it happened. Hey, let me just hit on that. Mitt Romney, you all know of him, right? Mitt Romney, pretty wealthy guy. Well, when he was running, I believe it was for president, right? I'm almost certain it was. Yep. When he was running for president, he had to disclose his financials and he showed his IRA. Okay, he just had a regular IRA and he showed it and he got scrutinized because of the growth in his IRA. Some of the best Wall Street people, the best in the business came in and said, that's impossible. There's no way your IRA could have grown that much based on the market performance. They spent so much time trying to prove that it was impossible. And he's sitting back just laughing at these people saying, you people don't understand what the wealthy do with money, do you? All of his money was in self-directed IRAs. He invested that money in startup companies, and those startup companies took off. Not all do. I'm not saying invest in startups, but he knew some things and they blew up, and his returns were probably thousands of percent, not hundreds, not 10, not 20, thousands. But had he not been in control of his money and known what the 4% know, that never could have happened, period.
Yep, absolutely. And people were like, how? Because with a Roth IRA, with any IRA, traditional Roth, any IRA, you're limited to like $6,500 a year into the account, into it. So people were always like, well, how did Mitt Romney have a Roth IRA with millions of dollars in it? Well, there's a couple strategies that he followed. First off, I believe, I don't know this 100%, I got to relook it up, but I believe that one of the things he did was take an old 401k, which we're going to talk about. He transferred it into a self-directed, but at the same time, he converted it into a Roth, which gives you and that doesn't work for everybody. It's not the right strategy for everybody, but it's the right strategy for some people. So we can talk about that. So there's a little strategy you can follow, how to take a traditional where you're going to have to pay the deferred tax. pay the tax on it now. Again, what are taxes doing? They're growing. So pay the tax on it now, but let's get into this Roth. Let's get into this tax-free vehicle, retirement vehicle. And then all that, you could grow that thing $1 million by investing wisely. You never pay a dime of taxes on that $1 million in growth profit. I mean, it's unbelievable what Roth IRAs can do. I love them, Chris. I mean, they're absolutely amazing vehicles if they're used properly, but people get bogged down. I even saw one of the questions like, well, how much can you put into a Roth IRA? Yeah, you're limited to $6,500 a year, but there's other ways to get around that. What if we open up a Roth solo K? How much can you put in a solo K, Chris?
Yeah, 56,000.
Up to, yeah, like 60 grand. I mean, depending on the situation.
Now, I mean, it changes every year.
Yeah, I mean, they keep raising it because, so there's so many other strategy ways to do that. But this all boils down to, hey, if you're going to put it in this account and rely on the stock market to go up over time, even though it goes like this, but over time it's going to go up, then fine, go be the 95%. But if you want to take that control, then pay close attention to this strategy, because this is going to allow you to do some really, really amazing things with your retirement and with your wealth creation.
Well,
so let's roll.
With regular Roths or regular traditionals, most people that have them, they think their only option, if they've got like a Fidelity IRA or maybe a Vanguard IRA, they might only have mutual funds that they can invest in. And anyone that's got mutual funds, really what you need to do is read that entire prospectus. Yes, that giant thing that they mail you. Oh, I'm sorry, they just email them now. If you read that and you understood that, you wouldn't invest in mutual funds anymore. That much I promise, because they're very expensive. And 99% of the people don't read the prospectus. Even if they did read it, they don't understand it. Then maybe you got yourself one of those good brokerage accounts that you can invest in everything, or so they say. You can invest in everything. You can invest in mutual funds, ETFs, stocks, and some other investments in there, but they don't let you invest in everything. Could you take your money in your IRA and invest in real estate? When real estate goes down, like if you had an IRA, and in 2009, after the economic crash, the Great Recession, could you have bought houses with your IRA? Most of you are thinking, heck no. How would I do that? I couldn't have used my IRA. Could you have used your IRA to loan money to investors to buy real estate and taken a profit in those deals? So split the profits on the real estate deal when you don't want to do the work? Because who wants to flip a house? I'm sorry. I did 267 flips when me and my wife were really doing the TV show, and I don't want to do them anymore. It's way too much work. So why do the work? Why not just be the bank and fund the deal? Take a split of the profit. Can you do that with your Vanguard IRA? Nope. Can you do that with your Fidelity IRA? How about your Charles Schwab? Oh, I'm sorry. How about your Robinhood IRA? You must be able to do that with your Robinhood IRA. Oh, no. Oh, but Chris, we have one of those self-directed Fidelity accounts. Self-directed for what? And we're going to get into self-directed, what you can and can't do. But really, your self-directed IRA, as they say with Fidelity, isn't self-directed at all. It just allows you to invest in any one of the investments you choose to invest in outside of the basket they provide you. Folks, I'm just trying to tell you what's going on out there. And we got to get our mindset right. And we got to learn what the wealthy know, the Mitt Romneys, the Bidens, the McCains, God, I could keep going on, the Walt Disneys, of the day, the Rockefellers, the Rothschilds. We got to learn what they knew, because what they knew allowed them to be in control of their money, to have the freedom. And it's not because of some luck or because they were born into a wealthy family. It's because they knew one or two things you don't know. This is one of them.
No, and you're absolutely right, Chris. And this might sound like an infomercial for self-directed retirement accounts, but the crazy thing is we are definitely not selling retirement accounts. We're actually going to give you one of these. So I know, and we could talk about that, but we're definitely not here to sell you retirement accounts. We're here to show you exactly how to use these to create unbelievable wealth for yourself.
Steven, I'm glad you brought that up. And I know Leroy's on here, and I just want to be clear, like the reason you've never heard of self-directed IRAs up to this point, if you're somebody that's just hearing about this the first time, is exactly what Steven just said. We don't sell self-directed IRAs. We can't get paid a penny on them anyway, because you're in control. We're teaching you things that the advisors, the brokers can't get paid to do. And because they can't get paid, you don't know about them. And I'm not beating up on advisors. I'm not. I'm simply telling you the truth about money. And Steven's doing the same. So folks, we're not selling self-directed IRAs. If you come to the 3-day event, you get one for free. And that's negotiated with the self-directed custodian so that you all can have access to that without having any cost. That's the incredible part. Can you move your, look at that question from Pamela, Stephen.
Yeah, I mean, yeah, it's so important that you utilize self-directed retirement accounts, both for yourself and for your business. I mean, Chris, I'll get to Pamela, but look at this next slide right here. I mean, this is what you can do with a self-directed IRA. And this is what we teach, creating wealth multiple ways. And we talked a lot about this on the last preview, but you can buy all types of real estate. You can fund all types of real estate. You can buy tax liens in your retirement account. You can buy gold, silver, precious metals, private business loans. You can, and like I said, startups into private businesses, becoming the bank. You can still, with your self-directed retirement account, invest in stocks. You can still buy options. You can still do everything you can with a traditional brokerage retirement account, except now you have all these other options as well. Intellectual property. I mean, how many of you are investing in Bitcoin? Are there any Bitcoin investors? Type I in the comments if you're investing in Bitcoin. Did you know you can buy Bitcoin in your retirement account? To me, Chris, that makes the most sense when it comes to Bitcoin investing, because Bitcoin is such a crazy volatile investment. I don't know how people sleep at night with active money invested. But if it's money, I'm 38 years old. If it's money that I know that I cannot touch until I'm 60, what am I going to do? I'm going to buy the Bitcoin in there, and I'm going to hope that it becomes adopted and it becomes the world currency and it goes to $1 million a coin. And guess what? I'm never going to pay a dime of taxes on any of that because I got it in my Roth IRA. How many of you like that idea?
How many of you like those apples?
But it's so true though. I mean, that if, and for all, in all transparency, I'm not buying crypto right now, at least not yet again. But when I do, that's exactly how I'm going to do it, just so you know. But this is everything that it allows you to do. And so let me just show you how the flow of this works. All right. So when it comes to buying real estate, and again, this is going to be important whether you're actually buying the real estate or whether you're lending. This is the process that's taken. So you have a current IRA custodian or the financial institution. What you're going to do is you're going to get on the line with the self-directed custodian, and they're going to help you do this. So there's some paperwork you fill out, and you contact your existing brokerage firm, wherever the money is now. And they're going to move the money from that where it is now, Morgan Stanley, Charles Schwab, Fidelity, whatever. They're going to move it over to the self-directed custodian brokerage firm, okay? Now, when that happens, there is no penalty. There's no tax consequences. It's a direct transfer from one brokerage to another brokerage. So there's no tax issues whatsoever that happen. Okay, is everybody clear on that? Once the money's in that account, it's now a funded account. Then what you do is you go out and you find what you're going to purchase. And whether that's a house, whether that's a business, whether that's a note, whatever the case might be, you're going to fill out what's called a direction to invest form. You're going to submit that to the custodian along with all the paperwork for the transaction. And the custodian is going to then wire or transfer the money to wherever it needs to go. It should be an escrow account. Once you have the money in there, then any money that comes out, any profits that you get through rents, any profits that you get through interest payments, any profits you make from the deal itself, once you cash out on it, all that money goes back to the custodian, back into your self-directed retirement account. Again, if it's in a Roth, it's all tax-free. Okay. So it's very simple the way that it works. There is another type of self-directed retirement account called a checkbook control account, which we can talk about. The only difference in how that would work is instead of submitting a direction to invest form and everything to the custodian for them to look it over and make sure it's all done right, you have complete control. And what that means is you have a checkbook that's linked to your retirement account that you can literally write a check to wherever the money needs to go directly out of your retirement account. So my one little warning for tonight is if you have a checkbook control account or you open one of those up, be very, very careful, because if you are at the store, as a dumb example, but if you're at the store and you pull out your checkbook to pay for groceries and you accidentally pull out your retirement account checkbook control checkbook and you write a check for some strawberries and bananas, guess what? That little transaction right there can disqualify your entire retirement account. And you do not want that to happen. Okay. So if you're new to self-directed investing, just be very, very careful using a checkbook control account, or let the self-directed custodian kind of do that for you at first, because they're going to look over the direction to invest form, look over all your paperwork. And if it's a not allowed transaction, if it's a transaction that the IRS says this is a no-no, then they're not going to let you do it. They're going to have be like a little added layer of protection in there. So just a couple examples. You cannot do transactions with family members. So like I couldn't buy investment house like from my dad, for example. See, or like a brother and sister. So you can't do it like within immediate family. And there's a couple other little transactions like that shouldn't and can't be done. Okay.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
A lot of people asking like, who are the best providers? And I'm asking people what they're using their self-directed IRAs for. You know, a lot of people are saying crypto, which is great because, you know, why not use your IRA funds for alternative assets, whether it's real estate or crypto, if you believe it and you understand it. You know, there's so many things. Or like we do, we lend money. Just like the banks, we lend money out. So, I mean, that's the biggest thing I do. I keep the questions coming in. And Pamela, I hope we answered your question there. It's just a qualified rollover. There's no taxes. So the 59.5 thing is only important if you're going from a traditional 401k to a Roth, because, and actually it really wouldn't be, you just have to pay taxes. You don't have to worry about the 59.5 year. It's a qualified rollover into that. And Richard, you know, probably started with a 401k or an IRA, and he's somebody I'm talking to now. But you guys are all doing the right things, you know, if you're doing self-directed IRAs. And some of you that aren't, we need to just learn about it. And once we get into the, Stephen, you got a case study that we're going to get to in a second. Man, every time we tell this story, it is literally the single biggest reason I started using self-directed IRAs. So I can't wait till you get to that. But no, I'm having a ton of fun with people's questions here.
Awesome. Awesome. Great. Keep them coming in then. Keep them coming. So let me show you a few ways to use a self-directed IRA, at least when it comes to real estate. First off, you know, obviously you can use the IRA to purchase the home direct. You can use the IRA to fund the deal for another investor that's buying that home direct as a private money loan. So you can do it as a direct investment. But here's where we get a lot of questions. Okay, well, you know, to buy a home in my area or to lend my money for an investor buying a home in my area, you know, homes are at least $250,000. Or after the rehab and everything, I need at least $300,000, right? Is anybody thinking that like, hey, I got $50,000, $60,000 or $20,000 or $100,000, but I don't think I have enough to self-direct and use this strategy. Is anybody thinking that? So let me show you how to get around that. So there's a couple ways. First off, you can co-buy with somebody else, or no, two ways actually. You can actually co-buy with your IRA and you vested separately. So what I mean by that is, let's say there's a $200,000 loan that I want to make right now to Chris Naugle. Chris Naugle's going out there. He's buying a house for 120,000. He's putting 20,000 in rehab in it. He's got 140,000 in it. We can sell that thing for $200,000, but Chris doesn't have that 140,000 to buy the home and do the rehab. So what's Chris going to do? Chris is going to look for a private money lender. Okay. So if there's anybody on here that's in real estate or thinking about getting into real estate and you just think that the money is holding you back, pay close attention to self-directed IRAs, because you're going to go out there and you're going to tell your neighbor, you're going to tell your friends and family, you're going to tell your dentist about self-directed investing. Because how many of you might know somebody out there that is worried about the stock market right now? That's worried, hey, I got all my money invested in these stocks, but we're at all-time highs and we think the market's going to come down soon, but we don't want to pull our money out because then the money's going to be sitting in cash. And we all know what's going on with inflation and cash right now, right? So we don't want that to happen. I can't put it in a savings account because what does a savings account pay? 0.5%?
0.0006%.
Yeah, 1% if you're lucky. So you're losing money in that. So what do? Well, you're going to go out there and say, hey, I'm getting ready to buy this house. How would you like to make some money on it and partner with me on this deal? Oh, well, I don't have any money later. Well, what about your retirement account? Where's your money invested? Have you ever thought about diversifying a little bit out of the stock market? All your eggs are in one basket in there right now. So there's so many different ways to use this. I'm just throwing out some different ones right now so you guys can kind of think about it and hopefully get some ideas. So what you can do is you can.
Sorry, Stephen, I didn't mean to cut you off. I've gotten 2 questions so far, and I'd love you to hit this before we get, too deep into this. Yeah. A lot of people have IRAs or retirement accounts, and they're over 70 and a half, and they're taking required minimum distributions, commonly known as RMDs. Does that work the same as a self-directed? I mean, is a self-directed the same exact thing as the regular Roth or regular traditional IRA? Can you just hit on that too?
It is. So if you're taking RMDs with your retirement account now, if you were to move that to self-directed, you'd still have those RMD requirements. Yes. But there's no RMD requirements with a Roth though, right?
With a Roth, there's not, but with a traditional, right. Yeah, Roth IRA is tax-free. The government doesn't get any of your tax money. So they're like, we don't care about you guys.
Right. And they
don't like the Roth IRA folks out there. I'll tell you that. The government doesn't like Roth IRAs at all. And
there's actually legislation. I don't know if it's passed yet or not, but I know it's changing some of the RMD ages and amounts and things like that.
It hasn't passed yet.
From what I see, it's going to be actually for a positive, but all it's doing is basically pushing people's retirement age back. I mean, right. But that's a whole nother situation. But yeah, I mean, you still have the RMDs. Again, a self-directed retirement account and a retirement account you have anywhere else is going to work exactly the same way. Same rules, same regulations, same requirements, everything. Does that answer the question?
Yes.
Yes, the self-directed Roth. Yes. Richard, the self-directed Roth is our favorite. Absolutely, for all those reasons. All right. So if you don't have a lot of money in your retirement account yet, you're limited to 6,500. Maybe you can't put that much in a solo K. Maybe you don't have anything to transfer over to get that nice amount in there right away. So maybe you're just starting out. So maybe you've been putting 6,500 in for a couple of years. So you got 13,000 sitting in there. Well, maybe you got, I don't know, $80,000 sitting in a money multiplier policy, or you got $100,000 sitting in a savings account or somewhere that's what's called non-qualified money. So not retirement money. Okay. What you can do is you can spend, you can use 20,000 from the self-directed IRA. You can use 80,000 from the cash account, wherever that might be. You can combine those together to make that $100,000 loan to give Chris the money that he needs to get that flip done. So you can put those together. Now, let me just say this real fast. If you do that, keep very, very, very good records, because however the money goes in needs to come out proportionally. So if you put $20,000 in and $80,000 in from cash to create $100,000 and you make $100,000 in that deal, well, $20,000 of that profit needs to go back to the IRA and $80,000 of that profit needs to go back through cash that you're going to pay taxes on. Does that make sense? Okay. All right. So here's another thing you can do. You can actually use your retirement account and leverage your retirement account. And when I learned this was one of the coolest things I thought, because when I first learned real estate back in 2000, when I started learning about real estate back in 2006, one of the things that really drew me to real estate, along with everything else, was leverage. The fact that I could go out there and I could buy a home for, well, at the time in 2006, 2007, with $0 down, and I could own and control a $300,000 house or property was unbelievable. Or you could go out even in traditional financing and put 20,000 or put 20% down and control much more, dollars worth of real estate. To me, that was really, really cool. The idea of leverage and leveraging what you have now to grow more. So that's what's really cool when I learned about self-directed IRAs is you can do the same thing. You can actually leverage your retirement account to get a loan to go out there and purchase more real estate. And what I mean by that is it's called a non-recourse loan. So a typical mortgage that you get, if you go to the bank, they're going to look at all your finances, your personal assets, all that stuff. If you go out and you buy a house today and you don't pay for that house, that bank or mortgage company could come after that house, They can come after you. They can come after your income. They can come after your savings account. They can come after everything that you have, right? Well, the money in a retirement account, one of the cool things about money in a retirement account is it's protected. Okay. Per IRS rules and regulations, money in retirement accounts is protected from creditors and debtors and things like that. Okay. So they can't come after your retirement account. So what you do is you get what's called a non-recourse loan. And what that means is if you were to default on that loan from the bank can come after that property to recoup their money, but that's it. They can't come after you personally. They can't come after your retirement account money. They can't come after anything else. So you can leverage that money within your IRA to buy a much more expensive piece of property and still take advantage of that. Does everybody like that idea?
Yeah.
It's just awesome stuff. And then of course you can also partner with another investor. So let's say I got 100 grand in my retirement account. Chris has got 100 grand in his retirement account. One of our business partners, Chris Rude, has a flip that he needs $200,000 to do. Well, I can give 100,000 out of mine. Chris can put 100,000 out of his. We create the promissory note. We create the contract, the mortgage. We give it over to Chris Rude. When he pays us back, let's say we make 50,000 on the deal. 25,000 of that comes back to me. 25,000 of that comes back to Chris Naugle. It goes right back into our Roth retirement accounts. We never pay a dime of taxes on any of that money. How many of you like that idea? There's two different types of self-directed retirement accounts. There's a lot of different types. There's IRAs, there's SEPs, there's 401ks, there's solo Ks, but there's two different types. There's what's called a checkbook control account, and then there's a regular self-directed account. The biggest difference is if I'm going to do a loan to Rude's Real Estate, for instance, and I have a checkbook control IRA, I can break out my checkbook that's connected to my IRA. I can write the check directly myself, and I can mail that directly to Rude's Real Estate for the deal that I'm doing, or not directly to him, but directly to his attorney or escrow company for the deal that I'm doing, along with the mortgage and the promissory note and all that stuff. But I can do it myself with a checkbook control account. Now, if you have a typical self-directed account, you're going to need to request that the custodian sends the money from your retirement account to wherever it needs to go on your behalf. And the way that you do that is through what's called a direction of investment form, a direction to invest form. So let me share exactly what that looks like with you. Again, there's a lot of self-directed companies out there. We personally use a company called Horizon Trust Company. If you're a money school or money multiplier student, or if you're in the private money club, you can also get a deal from Horizon Trust. They're going to waive the initial setup activation fee for you. So take advantage of that. You go right to their website, horizontrust.com, or let me know and I can make an introduction for you. You can put your name in right now. Just let them know you came from us and they'll hook you up. We also have an assigned agent from Horizon. Her name is Brandy Dean, and Brandy's awesome. So I can connect you directly with Brandy as well if you would like an introduction and a little more personal attention. But anyways, once you have the account set up with Horizon Trust, if you want to do a private loan, here's what you're going to need to do. You're going to need to hover over this little thing that says forms right here. You're going to click on, if you have a solo K or an individual K, you'll use these forms. If you have an IRA, either a Roth or traditional, you're going to use these forms. So I'm going to click this right here. This pulls up. So everything that they have is online. Like, they're a very transparent company. So if you want to see what an IRA application looks like, or a Roth IRA application, or a SEP or a simple or an HSA, you can click on these different applications and look at them. What are their account fees? Right here. If you don't know what kind of account, hop on with Brandy and she can tell you what's best for you. Okay, but this is what's most important right here. So this is the direction of investment form, the DOI or the DTI, direction to investment. Either one is what they're known as. So you're going to click that right there. It's going to open up a PDF. And then this is the form that you're going to need to complete if the funds for the private loan are coming from your self-directed retirement account. So you can do normal processing or express. They charge a little bit more for an express. So unless you're really, really needed to rush it, just do normal processing. If you do need to express it, then who is going to pay that $50 fee? If I was the lender, I would make the borrower pay that fee. If this is something the borrower has to close immediately, then make them pay it, right? Okay. Regardless though, click on whatever you got up here. Then you're going to put in all your information. What's the name of the investment? So that could be, Rude Real Estate LLC and the address of the property. So you know what the investment name is. And then what kind of investment is it? So in this case, this is going to be a promissory note and mortgage. So once you complete this entire form, which I'll go through with you, you're going to submit this form along with a copy of the promissory note and the mortgage or security interest. So the deed of trust, the deed of mortgage, or the security agreement. So you're going to do that along with the promissory note and this DOI form. That's what you're going to submit to Horizon Trust. Horizon Trust is then going to look through the form to figure out what they're doing. In this case, they know that they're going to be lending the money on a private money loan. If you're buying a piece of real estate, you would click that one. So it just depends on what you're doing. If it's a private, it's like a startup business or something like that, you'd invest there. But whatever it is, in this case, promissory note with the supporting documents, submit that to Horizon Trust. They're going to review everything, review all the documents, make sure everything's legal, make sure it's a transaction that's legally allowed to occur. As soon as everything's good, then they will process that form for you. And then what that means is they will then transfer the money from your retirement account and send it to wherever it needs to go. Okay. And then this also tells them what to expect for the money being returned. So if the investor knows that they're going to, or if the borrower knows they're going to be paying monthly interest, then so the money's going to go from Horizon over to the borrower's escrow account. And then as the payments are made, the money's going to come from the borrower back into your retirement account funds. So you never see it. You never touch it. The money leaves your retirement account. The money goes back into your retirement account. And then the money is going to either be in there growing tax deferred, or the money's going to be in there growing tax free, depending if it is a traditional or Roth retirement account. So on the documents, this is pretty important. So on the documents, you need to make sure that everything is titled properly. Because your account is considered to be the legal owner of your investments, all assets and documents must reflect this ownership. Failure to title assets correctly may cause delays and or tax consequences. The correct titling should be as follows. So when you're completing these documents, who's lending the money, you want to make sure you put this correctly. It's going to be Horizon Trust FBO, your name and the account type. So Horizon Trust FBO, Stephen Nagy, Roth IRA. And that's going to be the legal owner of those documents and of the loan, of the property, whatever it is. And that's what makes sure that it keeps its tax qualified status when it comes to the retirement account. So funding information and payment instructions, amount of funds requested. So how much money are you requesting be transferred from your retirement account to wherever it's going? Do you want to check? Do you want to wire the money? And then whatever the information is for that, that's up to the borrower and you and how you guys are going to work, how the money's going to go from where it needs to go to wherever. Then you're going to answer some questions. Again, this is to make sure everything's legal. So when it comes to self-directed accounts, sometimes there's limits. Like I can't lend to my dad, for instance, on a property, stuff like that. So you just got to make sure you fill this out properly. The disclosure, again, all the legal stuff, read through it, understand it, ask for clarification if you have questions. And then plain and simple, you sign it at the bottom, print your name there, put the date, submit this with all the supporting documents, and Horizon Trust will review it, they'll verify it, and they will process it for you. So that is a direction of investment form. All right, I have one question. Which company do you use for self-directed IRAs? I used Horizon Trust Company. So that's the company I was just showing, horizontrust.com. We have a great relationship with their owner and their team. I've known him for I don't know, man. I've known him for maybe 5 or 6 years now. Chris has known him for, I think, 6 or 7 years now, a little longer than I. Actually, the owner of Horizon is how Chris and I initially met. Yeah. Okay. Is it possible to lend money from my own self-directed Roth IRA to my own business in the form of a note? Typically not, Matt. They're call Brandy if you're working with us, or just talk with a self-directed custodian, or you can even Google it. What are disqualified or what are not disallowed deals when it comes to self-directed IRAs? And so again, like lending to direct family members can cause problems. Lending, like you can't do any work yourself. So as an example, like I couldn't buy a rental house with my IRA and then have my LLC that I own do the work on the property. That's not allowed. I can't even do the work myself as an individual. Everything has to be done by, it's like arm's length transactions, right? It's called arm's length. So there's a lot of that involved with it. So I don't believe you can do that, but I would just check with Brandy on lending from your IRA directly to your business. I think that's a direct self-deal. It's called self-dealing in that case. I believe that's considered a self-dealing transaction, but just double check on that one for me. All right. And the other thing is if you are transferring money from a financial advisor, from a qualified retirement account, an old 401k, from an old job, or an existing IRA, or whatever it is, if it's a direct transfer or a direct qualified rollover, there's no penalty, there's no taxes incurred. It's just a move from one company to another company. And if you do it with Horizon, they'll actually get on the phone with you and they'll call Fidelity or they'll call your financial advisor with you to make sure that they do it the right way. And so you don't have to like get on the phone and be like, hey, I want to move my money to Horizon Trust, and then you don't really know how or what to say. Like they'll do all that for you and with you. So Horizon Trust is really good with that stuff. So let them help you, like let them do that with you just to make sure it gets done the right way. Because if it's done wrong, you can get hit with penalties and taxes. So you don't want to do that, right? The thing to know about with self-directed IRAs is there's no difference between an IRA that you have that is through Fidelity or through Morgan Stanley or through, TD Ameritrade or whoever, and a self-directed IRA. There's no difference. From the IRS standpoint, they're treated exactly the same way. Okay. The only difference in them is who controls the money and what options you have for investing. That's the only difference. Okay. If you have a Fidelity IRA, a Fidelity 401k, they're going to allow you to invest in the stock market. They have some different lifestyle funds or mutual funds or index funds that you can invest in. That's gold funds, not actual gold, but gold funds, right? Self-directed IRA, through a self-directed custodian, somebody like Horizon Trust Company, are going to allow you to invest in literally everything else. Okay. So that includes real estate flips. That includes real estate rental properties, commercial, private funds, things like Battleborn Fund, which we'll talk about later. Physical, like actual gold, like not just these funds out there, but actual gold, so the Bitcoin, I mean, those of you that like Bitcoin, you can, and Chris, tell your favorite way of determining whether you have a true self-directed IRA or Fidelity, because Fidelity will tell you that you have a self-directed.
They sure will.
They pretend because they're letting you self-direct into their funds. Such a joke. That's how they're trying to keep up with all this stuff. But yeah. Chris, how do you test them?
All right. So Fidelity says you got a self-directed IRA. I want you to call Fidelity, call the 800 number on your statement and say, hey, whoever answers, just say, hey, yes, I just have a simple question. I have a self-directed IRA, or maybe it doesn't say that, you just have an IRA. I want to know, can I use the money in my IRA to buy a dairy cow? And they're gonna laugh a little bit and snicker and say, can you repeat the question? Yeah. I want to use the money in my IRA to buy a cow. Yeah, just a cow. Oh, well, sir, you can't really buy the cow, but we have funds, agricultural funds you can invest in. I think they invest in cattle and things. No, sir or ma'am, you don't understand. I literally want to go buy the cow. I want to bring the cow home and I want to put it in my garage because I don't trust the markets right now. And I want to then every morning before I go to work, I'm going to go out and I'm going to milk the cow. and I'm going to fill up a bucket, and I'm going to basically take that bucket out front, and I'm going to sell it out in the front of my house, and I'm going to get a premium for it. And that money then that I made on selling the milk, I'm going to send it back to my IRA because I think I can make more money doing that than I am in your Fidelity funds. So at that point, you will hear silence. They will either hang up on you, they will be laughing hysterically, or they will simply say, no, sir, you cannot buy the cow. Great. You've just learned you don't have a true self-directed IRA, because if you did, you literally could buy a cow. But believe me, that's not the most effective way to use your self-directed IRA.
But the fact that you are able to is what this is all about.
Darn
Because
right.
as it says on the screen, you, not your financial advisor, decides the type of investments you're investing in. You are in charge of your investment portfolio. And that is what Money School is all about, right? Taking back control, period. So change one thing to change everything, right? So here we go. So self-directed, as I said, it's the exact same. So you can have a traditional IRA, you can have a Roth IRA, you can have a self-directed 401k, self-directed solo K, self-directed SEP, HSA, simple. So all those types of retirement accounts that you can have, traditionally speaking, through traditional brokerages and houses like that, you can have a self-directed account. Makes no difference. The only difference is who controls that money, you or a financial advisor or the brokerage, right? So,
and we're not trying to beat up on financial advisors, but unfortunately, as an advisor, myself and Stephen were both financial advisors. We were not allowed to talk about this. We couldn't. It was called selling away. If you started telling people, oh, you should maybe put your money in a self-directed IRA because you want to buy real estate, we literally would probably get penalized. You could get fired. They can't talk. They can't talk to you about this. Do you know why? Because they can't get paid on this. Just like Stephen and I now, we're talking all about self-directed IRAs. And if you set up a self-directed IRA with Horizon Trust, guess how much money Stephen and I make? Zero. That's correct. It's because the things that somebody can't get paid on, the things that somebody can't make money on you from, they're not going to tell you about it. Privatized banking. Why haven't you heard about that? If it's so darn good, why haven't you heard about the infinite banking concept in privatized banking? Do you ever think it's because the advisor makes 60 to 90% less by doing it that way versus just selling you regular life insurance? How about this? Are they going to sell you a Fidelity IRA, or are they going to tell you maybe this self-directed IRA would be great and make a good recommendation to you based on your needs and goals? Well, no, they're not going to get paid on that. Their brokerage won't get paid on that. So that's why only 4% of all the IRAs out there are currently self-directed. I'm sorry, I'm getting pissed off, but God damn it, this stuff needs to stop. And people need to learn what's out there and how they can get in control of their money.
And it goes right along with what we were saying earlier with the IRS. The IRS says 95% of people are not going to retire the way they want to. So guess what? If you want to be one of the 95% of people that is not going to be able to enjoy retirement and live the life that you deserve, then keep doing what you've done and go to these financial advisors and invest in these funds and listen to Fidelity and stuff like that. But if you want to join entrepreneurs and what people like Chris and I do, then this is for you. And this is how you take back control. And yes, I get very upset too, because the fact that only 4%, less than 4% of all IRAs in this country are self-directed is mind-blowing. Who cares more about your money than you do? Nobody. And this stuff's not hard, all right? At all. This stuff is not hard, not rocket science. Anybody can do what we're going to teach you over these 3 days during this class. It's just a matter of learning something you've never learned before. And again, we can get into IRAs, and I could teach you the nitty gritty on how these things work and exactly every little detail about them. We're not going to do that right now. Just know that the point of them is you can take that control. And guess what? It's not just for you. All right. So this goes, a lot of the stuff that we teach is going to be two-sided. All right. And what I mean by that is if you're watching right now and you have $100,000 in an old 401k or a few, $500,000 in your IRAs or whatever, then great. Take that control. Let's get that money invested where you control it into these vehicles, things like real estate, things like taxes, things like gold and silver, things like private loans, things like investing in businesses. If those of you like Shark Tank, why not invest your IRA into startup businesses and things you believe in and things you want to go out? So this lets you do that. Intellectual property, cryptocurrencies, alternate coins, things like that. So this lets you take control. So if you have lots of money already, that's great. But this works on the other side of the coin too. So that's what Money School was born on, connecting these two sides of the coin, people with money that don't have money. And that's what that outer side of the coin is. And so, but if you're sitting here and say, well, I ran into some challenges a few years ago and I lost everything, or, I went through some tough times in my life through medical or through, my personal life, and I'm starting fresh again, or, hey man, I've been taking care of a family. I talked to, my mom's a single mom. She raised, so I get it, man. And life's a struggle. And, but the point is it doesn't matter, because these same techniques are going to work for you as well. Because think about it for just a minute. As Chris was saying before about how to use HELOCs, if you approach to somebody, your neighbor, a good friend, a family member, or whatever, and be like, hey, let me teach you about another way you can invest your retirement money. Hey, are you worried about the stock market dropping and losing all your retirement money? Most people are worried about that right now. So how about you go out there and you educate them and you teach them an alternate way to invest, and you teach them how to take back control. Guess what? You show them how to do this. You think maybe they're going to be willing to lend you some money to go out there and do your first flip, or go out there and start your new business? Absolutely, they will. Chris's mentor, my mentor who introduced us, Greg Hurley, this is how he got his start, was going out and teaching other people how to use retirement accounts and teaching them self-directed IRAs. And now he owns a self-directed custodian company. So it's really neat to see it all come together in full circle. So it doesn't matter whether you have money and you're looking at how to take advantage, or you need the money. You need to learn self-directed investing, because that's where all the money is. Look at this. Trillions of dollars. This is an older stat now. The number, there's more IRA accounts in this country now, but trillions of dollars out there, 79 million IRA accounts, and 4% of them are self-directed. Think about that. That means there's 96% of the country is an opportunity for you to go out there, teach some of this stuff, and get their money for your deals. Does that make sense to everybody? I mean, just the opportunity is unbelievable.
And it should. Stephen, let's play a little role play, because with self-directed IRAs, an important thing to understand is if you set up a self-directed IRA and you roll over an old IRA from Fidelity or a 401k into this self-directed IRA, remember, you have to direct that money. So let's say you get into real estate. The first thing you should not do is use your own IRA to go buy your own properties, because it's self-dealing. There's a lot of rules. Your custodian can help you with that, but it's difficult. You're going to need a good CPA, and you're going to have to follow the rules. But what about this? What if I had a self-directed IRA and I met Stephen at a RIA and Stephen had a self-directed IRA? Now, when I find a deal, I go to Stephen and I say, Stephen, do you want to do this deal with me? And me and Stephen partner, or he becomes the bank on my deal and lends that money to me. He didn't violate any rules. We're not related. There's no self-dealing. And then all of a sudden, Stephen, a week later, finds a deal and he comes to me and says, Chris, I know I'm funding your deal, but do you mind funding mine? And I've got this IRA and I fund his. So now all of a sudden, each of us have a method to move our money, and we each trust each other because we went to the same RIA. Well, think of Money School as that RIA. Money School is that community where you can build those relationships. This 3-day training, you can meet those people that are learning the same thing as you are, so that you then can build relationships and lend money. Just today, I got a deal on my desk to fund. And what I did is, somebody that I know, a friend who had a small self-directed IRA, I said, hey, do you want to get on this deal? So he's lending on the deal with me. So I'm using money from my banking policy. He's using his self-directed IRA. We're both going to fund this small $40,000 real estate deal. That's because of the power of a community and the power of your network. This is your network.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.